Thank you for tuning into this update. I'm Joshua Dobie. Appreciate so much you taking a few minutes here as we talk a little bit about how we ended up last year and how we have now gone through what is already the end of the first quarter of 2026. A lot has been happening. I don't need to tell you if you've watched pretty much any news program, certainly anything geopolitical or business related, you have seen a lot of the headlines I'm going to be talking about here. But I would just want to touch on them to review them a little bit with you, and then also to give you a few of our thoughts, not only about where we are, but of course, the big question, where we see things for the balance of this year. So I want to be respectful of your time. We're going to go ahead and dive right in. It has been a very, I'll call it a tumultuous start to 2026 as we get in close here to the end of the first quarter in 2026. We had a great 2025. There was, as measured by the most popular stock indices, again, a very, very positive year. I'm looking at the Dow Jones Industrial Average, the S&P 500 Index, and the NASDAQ Composite, all very notably positive at the end of 2025 year. That marked 3 years in a row where we had a significant, even above average performance in each of those stock indices, and as a result, a number of the stocks inside of those indices. Now, as you know, that doesn't mean that every stock that had a positive year last year. Actually, it was concentrated, especially the biggest performance numbers that we saw was concentrated again in the large capitalization technology companies. I'm looking at Meta, I'm looking at Google, I'm looking at Netflix, Palantir, those kinds of large technology companies, which have really become NVIDIA, can't forget them, which have really become so much a part of the market vernacular here in the last several years. Those really were the ones who powered the market through the course of 2025. Now in 2026, we had a relatively, I would call it a benign start to the year, at least insofar as market indexes are concerned. But then things turned pretty tumultuous. And then here in the last 5 weeks or so, as we have engaged in war in Iran, in the Middle East, we have seen quite a bit of volatility in the market. Now, in a lot of ways, this wasn't unexpected. And I'm not talking about the fact that we were thinking we were going to go to war with Iran in the Middle East, but rather we knew that after 3 consecutive years of way above average market performance, that we were due for some level of correction. So whether it was due to a geopolitical event, some kind of macroeconomic event, or something else just completely unknown, we knew we had to have a little bit of a reversion to the mean. So the market performance, as we've seen it to this point, not entirely unexpected. And so when we see this kind of performance, it's something that, frankly, as counterintuitive as it may sound, we actually need to have this with some regularity in order to maintain a healthy market. Not speaking at all to the military engagement, the political impacts of what we're talking about here, but rather strictly to market performance. Very technically speaking, we need to have some level of reversion to the mean with some regularity in order for the market to remain healthy. So that's what we've seen here over the last 5 weeks or so. We've also seen what we would call internally here at North Main Financial Group some market rotation. Now, market rotation that we're defining for means of this discussion means that those things which were performing well have now been not performing as well. And other things which were largely being ignored, especially for the last year and a half or so, now coming to the forefront in terms of very positive performance. So as you heard me mention a few moments ago, the large capitalization technology sector really powered the performance inside of the market indexes, not just in 2025, but in 2024 and 2023 as well. Now we've seen those same technology companies pull back quite a bit. And when I say quite a bit, I'm talking about 15, 20, 25, 30%, even more off of their highs. So quite a bit of pullback, especially in the large cap technology sector. Where we've seen things come to the forefront, again, in a couple of sectors that really hasn't been the case here for the last couple of years, and maybe some things that have been off of your radar screen, energy. So I'm looking at oil, natural gas, having very positive years here since January 1st, and also utilities, which again have largely been, I would call them benign in terms of market performance, now doing very, very well here in the first quarter of 2026. So what does all of that mean? Well, a whole bunch of different things. And I'm not going to take a thesis argument here in terms of the longevity of my discussion with you, but rather to say that there are a couple of big points that I think would be wise for us to keep in mind, not only for where we are right now in 2026, but most importantly, always as we look forward and for the balance of the year. So let's just take a real quick recap on where we are. You heard me talk about utilities and energy stocks specifically doing very, very well in 2026. Technology largely pulling back. Certainly a lot of geopolitical uncertainty right now. As we're moving towards the end of the first quarter here, as of the time of this recording, still no resolution as far as what may be what sometimes is called the off-ramp in terms of the war right now in Iran and what that will look like. So no real data there, no real thoughts there, other than the thought that we know at some point it will resolve. And in doing so, it appears, at least insofar as some of the short-term market performance has been, that the market is going to have some level of recovery. Now, that doesn't mean at any point that we're implying that it's going to automatically return to where it was. No way for us to know that. It might, or it might not. But what does seem to be true is that when the market has some level of certainty, not pure certainty, but some level of certainty about how things are going to resolve, there tends to be a shift in focus back to more macro fundamentals as far as the economy and the markets are concerned. So as we're looking at where we are right now with all of the uncertainty from a geopolitical standpoint, we anticipate here at North Main that there is going to be some level of refocus as we move beyond it, and the markets will start focusing on some more macroeconomic factors. Now, as is always the case, we have some positive macroeconomic factors and we have some negative macroeconomic factors. So what's going to win out? Well, of course, we're going to have to wait and see a little bit. But what we know to be true, whenever those kinds of circumstances happen, that when there's more a focus on the fundamentals of individual companies, specific sectors, when it comes to where we're investing, that tends to be an indication of a healthier market. So on the positive side of things, we still have relatively low unemployment. We still have a pretty moderate inflation. I'm going to caveat that a little bit by saying we've seen a spike in inflation here during the time of this war with Iran, but it seems like it could be true that as that resolves and the Strait of Hormuz is opened up again, that we will see some pulling back of oil and energy prices, which has a trickle or a domino effect, if you will, on a whole host of other things, including food production, fertilizer, etc. So there's going to be some level of moderation that we see as we have some resolution here in the Middle East. Now, in saying that, so on the positive side of things, we've talked about utilities, we've talked about the energy and oil sector, we've talked about technology really pulling back quite a bit. Does that mean that those kinds of things are automatically going to rebound to where they were? Not necessarily. But it's probably true, and this often happens during times, especially of geopolitical uncertainty, that there's going to be some kind of relief rally at some point. How long will it last and how sustained will it be? No way to know at this time. What we do know, though, as I talked about with unemployment, as I talked about with inflation in a relatively controlled kind of space, with the caveat of some of the things that are having to do with the energy sector right now because of the war in Iran. In those kinds of instances, from a macroeconomic standpoint, that tends to be a positive thing. Now, on the negative side of things, we're looking at higher cost of living, and we're seeing this across the board right now. We're looking at it in terms of interest rates when it comes to mortgages. We're looking at it in terms of the cost of rentals or rents, if you will, for apartments, condos, and even single family residences. We're looking at increases in cost in the grocery store. And of course, right now, we're definitely seeing some increases in costs at the gasoline pump whenever we're fueling our cars. So those kinds of things tend to slow down economic growth. And so we're going to need to watch and see what kind of impact that is going to have over the long term. Probably at some level, that is going to be a function of how long it will be until there is some kind of conflict resolution here in the Middle East. And while that's not a one-to-one kind of comparison, that tends to be the case. So we're going to be watching that very closely. As we look towards the balance of the year, as I mentioned at the forefront of my remarks here, this actually kind of reversion to the mean, as we described it, is a healthy thing. I know that's counterintuitive, and I know as you get your first quarter statements and you're going to see some numbers pull back maybe a little bit from where they were here on January 1st, you're not going to have a good feeling. I'll tell you, I'm not going to have a good feeling. That's just just part of it, and that's a very natural kind of reaction to those kinds of pullbacks. However, again, as counterintuitive as it may seem, that actually is a healthy thing. And we need for that to happen periodically in order to A, make sure that the folks who are invested are truly invested, because what can happen periodically is we get what's called hot money into the system, money that comes in very, very quickly and then leaves very, very quickly, creating some more volatility. Sometimes with a pullback in the market, some of that hot money leaves, and that actually is a healthy thing. We also have some other parts of the market which are, I would say at the very least, causing some increased conversations. Had a lot of conversations with a lot of you about the private credit markets. Now, let me define that for just a minute. Private credit, generally speaking, is what we sometimes call alternative financing options, where folks who want to take out a loan, usually for business reasons, instead of going the more traditional bank or bank financing route, go with a private institution. And that private institution may use their own capital, or they may use capital that they've raised from other investors, and then they offer it to folks who are in need of a loan or business financing. Generally speaking, on the business side, doesn't tend to be so much on the personal side of things. Usually we're not seeing this in things like mortgages or things of that nature. But it has become a very large market, frankly, and has become a very lucrative market with private credit for a number of our financial institutions that are out there. And we're starting to see some cracks in the system, meaning we're starting to see where the margins that were anticipated and, frankly, the credit worthiness of some of the players involved maybe wasn't as sparkling as it was anticipated to be. Now, before I go too far down this path, the follow-up question a lot of you have had is this like the mortgage crisis we had in 2008 and 2009? No, it is not. We're not seeing the kind of leverage that we definitely saw on, say, mortgage-backed securities there in 2007, 2008, 2009, which caused a real tumult in the system. We're not seeing that kind of thing, but we are seeing where there are going to be financial institutions which have been and are going to continue to be negatively impacted as they work through the portfolio that is their private credit exposure. So continue to keep that on your radar screen. It's something we're certainly watching here. We don't expect it to be a cataclysmic kind of thing in any way, but it is something that is negatively leaning on the markets right now. And we're going to continue to watch as that develops here over the course of the next weeks and months. But as we're looking forward again to 2026, just to recap a little bit, we anticipate some level of resolution in the Middle East at some point. We also have a big mountain out there, certainly in terms of the political landscape and also in terms of, let's call it the perception in the markets, and that is the occasion of midterm elections coming up here in November. And what that may portend in terms of specifically fiscal monetary policy, depending upon what happens in both the House of Representatives and the Senate at that time. More specifically, if things change in terms of the majorities, and certainly if they flip altogether, that will have an impact in terms of what kinds of fiscal and monetary policies will move through the system here over the course of the next couple of years. So we're watching that very closely for the obvious reasons. That's another big one that's out there. But as we get some settling from a geopolitical standpoint, we anticipate that there is going to be more of a focus on the more fundamental and perhaps even some technical aspects of the market as we make our way through 2026. Interest rates, another big question that we receive from a lot of you. Where do you see them? And specifically, and I understand that the direct correlation that sometimes is drawn, even though it's not purely direct. What does that mean for mortgage interest rates here for 2026? It's possible that they may pull back a little bit, but we don't see that a whole lot at this point. As a matter of fact, at least insofar as the long end of the curve on the bond market is showing, they're not anticipating any rate cuts at this point for the balance of 2026. Now, that can change on a dime. Certainly it does, and it certainly can. We're probably going to get a change in the Fed board chair come here in May, and that may have some impact as far as what the Federal Reserve Board of Governors does. But remember, he's only one vote, and there are some very strong personalities on the Federal Reserve Board of Governors who definitely have their own opinions, so that they may not be unnaturally swayed by the Fed board chair when it comes to that time. So what I've cautioned folks to do is don't anticipate we're going to get a cut or certainly more than one cut here in 2026. At least at this point, we're not seeing that, which probably means some level of stasis insofar as mortgage rates are concerned. Now, just because the Federal Reserve doesn't cut rates or increase rates doesn't mean that that's necessarily where all rates are going to stay, especially those that are linked to the 10-year Treasury or the 30-year Treasury, because we've seen a lot of movements in those interest rates here just in the course of the last several weeks. So what I encourage folks to do is don't anticipate too much that we're going to see a reduction in rates for the balance of 2026. Be cautious, be flexible, certainly when it comes to your financial positioning. But again, as we're looking at it for the balance of the year, what we're encouraging folks to do, as always, is to stay flexible financially, but also to be diversified. This year is a perfect example of that, meaning that what worked last year, frankly, isn't working as much this year. And some of the things that were largely ignored over the last couple of years, now those are the things which are starting to come to the forefront. That's why it's important to be hedged. That's why it's important to be diversified when it comes to your overall portfolio. So again, I appreciate you taking the time here to listen to these remarks. And as we're thinking about the balance of 2026 and all the positives and negatives, which are always present in these kinds of instances. As always, if you'd like to reach out to us to talk about your portfolio, to talk about where things are for you, we're getting into the spring season finally. Although some of you folks who are in the upper Midwest, I'm looking at you in the Upper Peninsula in Michigan and Minnesota and the Dakotas there, you may not be thinking we're getting into much of spring yet. But for much of the United States, we're getting into the spring season. Certainly a welcome as so many parts got so much winter this past season. So definitely looking forward to that kind of thing. It's baseball season. We had opening day here last week. If you're a Pirates fan like me, our ace had a rough first inning. I was going to say first outing, rough first inning, but I anticipate that Skeens is going to be back on the bump there before too long, probably looking like his Cy Young award-winning self. And maybe that's just hope springing eternal. But if you're a Pirates fan, you got to have a lot of hope when it comes to the baseball season. But I hope this finds each of you well, and I appreciate the time that you've spent in listening to us here. As I mentioned, as always, if we can help in any ways, never hesitate to reach out to us. Always happy to hear from you. And until that next time, I'll look forward to talking with you soon.